Welcome. Thanks for joining us today for the third and final webinar in our series on PPP loan forgiveness. A couple of things before we begin. If you look in the Q&A section, you will see a link to our upcoming end of year accounting webinar series. I have also posted a link to our 2 previous PPP webinars and a link to sign up for our monthly email newsletter, which includes the latest accounting news, updates, and announcements. Now let me introduce you to our awesome presenters. Today we have Megan Bronson, and she will be joined answering questions by Tim Larson. Tim is a CPA and advisory partner here at Squire with over 40 years of experience in public accounting. Tim provides expert business operation and management consulting. Megan is a CPA and advisory partner at Squire as well. She has over a decade of experience working with businesses across several industries, specializing in QuickBooks consulting and outsourced accounting services for manufacturing and distribution clients. So with that, we'll let Megan take it away.
Wonderful. It's great to be with you again today. We're excited for another deep dive into our payroll protection program forgiveness. Just to give a little bit of context, we are going to just review some of the things that we've already covered in the last 2 sessions. There are definitely going to be links to those recorded sessions. If you would like to review them, you'll have those links in the follow-up email that you'll get today. And so let's go ahead and dive in. But the biggest thing I have for today is I want you to have the opportunity to ask questions. And so please use the Q&A to ask questions. On some of them, we'll try to just tap private responses to you. If there are things that we can talk about as a group because we feel like it's beneficial to everyone and we have time for it, we will. And so listen or watch for responses to your questions. And so I do have material to cover. A lot of it is review, as I mentioned, and then we'll dive a little bit more into those into the loan necessity questionnaire because we kind of breezed through that last week, and so it'd be good to dive in a little bit deeper on that for anyone who has that as one of the questions they're hoping to dive in on. So as Whitney mentioned, we have Tim and I who are both here to help out with any questions you have. We're excited to share our knowledge and our experience so far. So first, we're going to go through a quick review of the PPP forgiveness. This is a lot of these slides are duplicated from the last few weeks, but just to keep you aware of the current legislation that's happening. Two new updates to this, I guess I would say. One is on the 3rd line of the IRS taking a stance that costs are not deductible. That still stands at this point in time, but just last week the multiple CPA associations throughout the country drafted a letter with I read at least 30 states on that, if not more. Were part of this letter to Congress saying, please fix this. We know the intention was that these things would be deductible. And so please fix this so that going forward, we can get the cost taken care of so that people aren't filing their 2020 returns with having to take these costs off from their deductions. And so hopefully that is a loud and clear message to Congress. Hopefully they will act on that, and hopefully we'll see some movement there shortly. And then the last bullet point, another round of PPP funding. Just, every day we're watching updates. It looks more and more likely that there's going to be another round of PPP funding. We are not sure of the terms at this point. We don't know whether it will be smaller businesses only, like in the 100 or less employee range, or if it'll be anybody, or if it'll be exclusive to specific industries or people who didn't get it last round. We don't know what the parameters are, but watch for that. We definitely will be out there talking and having webinars around it once it's there. And just so you know, there are, you know, some of the lenders, you know, you may or may not have had a good experience this round. If you had a great experience with your lender, definitely watch for them to be ready for this next round. Some of them will be ready right away. Some of them will not. They will sit on it for a little bit. So if you're waiting on your lender, or if you maybe didn't have as great of experience as you thought you should have, we do have other resources. There's a lot of financial tech companies out there who are doing, making this process streamlined for the next round of PPP funding. They've taken the risk that they think this next round is going to happen. So we're happy to help you if you need to find a funding source for this next round. So please watch for our newsletters and notifications out there on social media and everything so that you know when to be watching for those applications to open up, should they open up. Okay, so just a quick review on the different forms, the different application forms. You've got your 3508S, that's our simple filing. It's if you're 50,000 or less. There's very little substantiation required on this. You are basically saying, yes, I spent the money, and depending on your lender, they may want to see some proof of that, because technically you could get audited over the next 6 years and have to prove that you had spent the money. So the banks are trying to just say, well, let's gather it now just so that you don't have to scramble for it in 5 years. The next form, 3508EZ, that's if your loan is over 50,000, but you were either a simplicity or safe harbor scenario, meaning you don't need to do an FTE or wage reduction analysis. So simplicity would be like, I'm a Schedule C owner with no employees, or I did not ever reduce my workforce. We just kept coming along. And a safe harbor scenario is more like, I couldn't reopen my business in time. Like I still have restrictions. I can't rehire all my people because I'm not allowed to, from a health code, you know, restrictions on how much capacity I can have at my restaurant or hotel or whatever it is. Form 3508, that's the normal form, that's the original form. That's going to be for anyone who's over $50,000. There's no upper limit to this, but you're not easy. You're not the easy version. Everyone will file a normal 3508. And this 3508 does include the FTE analysis, and it does include the wage reduction analysis. Then we have our form 3509 and 3510. These are what are required of all PPP loans over $2 million, and likely any loan pulled for audit will ask these questions. It's called a loan necessity questionnaire. That's something that should come into play before you achieve forgiveness. So if your process goes through and you get notified that you're forgiven, then and you didn't ever get asked for this form, if you're for-profit or not-for-profit, then you don't have to worry about it at all. So it's not something that's gonna, it's not gonna be pulled, you know, in a month or something after you've achieved forgiveness. Only if you happen to be pulled for audit down the road, the next coming years, they could ask for this data. But if you get that free and clear, like I'm good, I got forgiveness, then you're probably safe to not have to fill out this form. Next, just a few bullet points on forgiveness spending. We talked about our covered period is going to be on the day you receive your first loans. Most banks gave you your loans and your loan monies in full on a disbursement date. That's the date that your covered period starts, and then it is ending either 24 weeks later, which is almost 6 months, or December 31st. So only for those people who got their loans in July will the July or later will the December 31st cap happen. But for most people, it's going to be a 24-week is going to be where things expire. If you did have an earlier loan, you could qualify to the 8-week covered period, which is what the original PPP loan was set up as, because back then we were all naive and thought COVID was a temporary quick thing. And of course it's not. But our experience is that banks are asking businesses to use the 24 weeks process so that they can do payroll costs only, so that the bank doesn't have to sit there and go over all of your other expenses, your lease payments and your utilities and things like that. And so for most, you're going to choose the 24 week, and you can get away with just having wages. You don't have to consider benefits or payroll taxes or anything or any other costs. You can just do payroll wages. So you can file early if you would like. You don't have to wait the whole 24 weeks. If you do file early, your employee wage limitation, which is a limitation that annualizes everyone to 100 grand for the year. So if you're on the 24 weeks, it's like a 46,000 limit. But in this case, if you say, okay, I've spent all the money and I want to file for forgiveness at week 20, then you have to take that 20-week limitation against 100 grand. So you take $100,000 divided by 52 weeks times however many weeks you're filing for. So that is what you would have to limit each employee's wages during the covered period. If whatever you paid them during that time, you can't claim more than that proportional amount of 100,000. The FTE analysis that you're doing doesn't actually fall in line with the covered period, as in your weeks that you're filing expenses on. The covered period for FTE is still ticking until you either hit that 24 weeks or you file your forgiveness loan application. And so if you, let's say you cut it off at 20 weeks, which was the end of November, and you're going to file for forgiveness this week, then you're going to have to report FTE analysis has to include this whole past week, the whole week, even though it's beyond your 20-week covered period of costs. So that's an interesting dynamic that shouldn't really affect too many people, but that is something to note. Some complexities, we did talk about these in last week's webinar. It's an FTE analysis. The aim here is to compare apples to apples and determine whether you had a reduction in your workforce, and if you did you have a restoration to your workforce? Hopefully those PPP monies you received helped you rehire people. And so there is an analysis there to see whether you reduced your workforce and whether they all came back. If you don't get them all back, then there are a few exceptions and safe harbors, as well as there are some, there could be that you are stuck with a I don't want to call it a penalty. It's a reduction in your eligible costs. And same on the wage reduction analysis. It's trying to determine whether you took anyone's pay rate and reduced that as a way to stay afloat. Someone was getting paid $20 an hour and you said, hey, I can't afford 20 an hour, but I can afford, 13 an hour. Can you take that? And so you start paying your employees a lot less per hour. Then whether they're salary or hourly, if you're paying your employees less per hour, then you are, then hopefully the PPP monies allowed you to restore that wage. And so it's analyzing whether you took a more than 25% reduction. So if they were paid 20 bucks and you started paying them $16, that's acceptable, it's okay. But if you went down below the 75% mark, which would be $15, you're going to have some penalties there. And there are safe harbors that allow you to ignore that person, things like that can come into play. But if you don't meet the safe harbors, then you would be looking at another reduction in your payroll costs. And on these two, by the way, they're not the end of the world. We were scared about these early in the process, but with the 24-week extension of the covered period, we were able to we come saying, well, my loan is only $400,000, but I have payroll costs of $800,000, and so therefore, with that $800,000 cost, sure, I could take you know, a 40% reduction to that if I still haven't been able to hire my people back, and it's okay. And so we've kind of had this this attitude of it's okay to have reductions from these complexities, from the FTE and the wage reduction, and so we will make sure that we don't have to go through the extra effort of doing all the safe harbor things to try to negate it. It's okay to be reduced. One question has come in. It said, we laid off employees off in January and February, not in response to COVID. What is the best way to not have this penalize on us on FTEs? That's a great question, because one of the comparative periods, so we'll talk, I have some slides later that maybe we'll rehash this, but I do want to respond to this question right now. You have your covered period, which is, you know, from the date your loan started till once you got those money for the 24 weeks. You're doing a calculation of what is my average FTE during that time. And we'll break that calculation down later, and we did last week as well. And then you have to have a comparative period. So the comparative period, you get a pick. It's either January and February of 2020, or it's February 15th to June 30th of 2019, a comparative period. And so you're looking for that average during those two different times. And then you get a pick which one you use. So you're going to say, well, my covered period says I have 30 employees. My January period says 31 employees. My 2019 period says I had 40 employees. And so when you get to that analysis, you're going to say, well, obviously I don't want to use the 2019 number because I don't want to go from 40 down to 30. But going from 31, which is my January, February number, down to 30 is no big deal. And so they're not really looking for reasons as far as why you let people go or why things compare one way or another. It's up to you. You have that choice to choose the most advantageous comparative period for you. So the last thing on here, the other complexity, as I mentioned already, is the loan necessity questionnaire. I am going to dive into that later on. And so it's really trying, back when the loans first started, there was, when the loans first came out, a lot of big banks went to their high worth clients and said, let's go get you this money. And so a bunch of high worth individuals and businesses got this money, and then socially that became known and became unacceptable socially. And so then there was this big push to have these public companies and high worth who could have pulled down money from their owners easily. They said, please return the money, and they kept extending the deadline to say, you can return it, you can return it, you can return it. And so this is their way of coming back and saying, okay, all the people who didn't return it, did they really need that money? And so it's going to ask certain questions, and we'll dive into that a little bit. Alrighty. So next we're going to jump into just the accounting for this. And I haven't actually covered this in the prior session, so hopefully this is helpful for you. But first, before the loan is forgiven, you need to have the PPP loan set up as a long-term liability account. Because if you don't achieve forgiveness, then it's going to be repaid over 2, 3, 5, 30 years, depending on the size of your loan, and so you and the bank will work that out. The EIDL grant, a lot of people got up to $10,000 as a grant right away, pretty quickly. The money came in. That does not need to be repaid, so it should have gone in as an other income account. Once you achieve loan forgiveness, you're going to set up a PPP loan forgiveness account as an other income account, because this is not an ordinary income. This is not something that happens in the normal course of business that you're getting forgiven for government money that you received. And so you set up that other income. It's as simple as you debit your PPP loan liability, you credit your loan forgiveness income account. And then there are going to be those who only have partial. So when you're debiting and crediting the loan liability, you're only going to do the forgiven portion of your loan. We do have for if you don't have the loan fully forgiven, you will have interest expense. It's been accruing all along, and so therefore you're going to need to debit your interest expense for how much is accrued and credit the loan liability for that same amount for what remains unpaid. And then when you pay those balances, it's like any other loan at this point. You credit cash because you're paying out cash, and then you're going to split your interest versus principal. Your interest going to interest expense, your principal going to the PPP loan liability. So I hope that kind of, it's simple. It is what the AICPA is guided as far as the treatment of it. If you don't achieve forgiveness until 2021, then this loan stays on your books, and then your other income will hit in 2021. We have started seeing some clients come through with forgiveness. And so I'll give you 2 quick examples. One client, they had around 200 grand as their PPP loan. They were able to achieve full spending with the 8-week calculation. So we actually submitted the full application with their bank on their bank's portal at the 8 weeks. And then the lender came back and said, hey, can you please just submit it on their 24 weeks, but with wages only? Because I'm pulling out their copier lease, their utility payments and everything to get that 200,000 of expenses originally. And the bank just didn't want to review all of that. And they said, we think if you go with 24 weeks, you can do it with wages only, which completely simplifies our process. We just have to understand your payroll reports, and then we're just going to go check it off, until we get enough costs to be forgiven for. So we did, we resubmitted it, and then we actually achieved forgiveness. This is just last week that we achieved forgiveness, fully achieved within 3 weeks. So the bank had submitted to the SBA, and within 3 weeks it was back. So that was really a good experience. That was exciting that they're like, oh, by the way, it's done, thanks. And it's just that quick journal entries to get it off your books, and really, you've got all your documentation with your lender and hopefully your accountant, so you're golden. Another one, we had all but the EIDL grant portion of forgiveness was achieved. So this client, they had a small loan, PPP loan amount of $35,000. They also received the EIDL grant of $5,000 because they had 5 employees. And so they actually submitted an easy application with the bank on their own because they did this before the S application showed up. So anyway, so that's a side note, but they submitted on their own. And then the partial forgiveness, it took about 5 weeks before the bank got back, or the bank told them it was forgiven from the SBA. So when that happened, the lender said, all right, client, here is your accrued interest and portion of interest that was forgiven associated with the portion of the loan forgiven. So they were forgiven $30,000 and of the 35. And so they said, here's the accrued interest and here's how much of interest is forgiven, netting out to be like $40 of interest or something that had accrued so far. And then they established repayment terms. And I was a little bit surprised by this, that full repayment was starting now, 17 monthly payments, around $300 for the unforgiven $5,000 plus 1% interest. So they'd have full repayment. It'd be totally fully repaid by April of 2022, which is 2 years of the original loan date. And so I think because of the size of it, they just said, let's just get this over with. I think we're going to see banks handle this differently according to the size and complexity, and whether it's partial forgiveness or full, like they have to fully repay. And so there's going to be some interesting repayment terms that I think we'll see. I think that there's room to push back if your bank comes back with repayment terms that you cannot do. Especially because of COVID, I think that there's room to push back because there's been guidance saying they shouldn't have to pay anything back for at least 6 or 8 or 10 months or something like that. And I mean, I have not memorized what those restrictions are, but the banks should be willing to work with you to make sure you're able to repay that money in a way that's suitable for you and falls within the guidelines that the SBA set. But if I were a client and I owed them $5,000 or $10,000 for this EIDL loan, and I had a $2 million loan, I'd probably just say, here's a check. Like, I don't want to pay you $300 a month for the next the next 2 years. That's just so much administrative. Like, I have the cash right now. Let's just get it off my books. And so I could see a lot of people turning around and just paying it off with the bank and settling on it so that it's just done, if it's just this EIDL loan portion. And then I don't have any examples of partial loan forgiveness because I think that when that's going to come into play, we will have had some interaction with that form 3509, 3510, and therefore those are going to take a lot longer. If your loan's a lot bigger, it's going to take longer for the bank to do their part and for the SBA to do their part. And so these were both small enough that they were quick turnarounds, and it's been a good experience so far. Let's check on questions real quick. All right, so we have in our forgiveness paperwork, do we need to match the GL? I've been tracking where my expenses have happened throughout this time. But if I turn around and submit an application that's only wages, then it doesn't necessarily match my GL on this. And the answer is no, there's not any cash flow tracking as far as what the SBA or the bank even needs to see of you receiving the money and turning around and paying it the next day. Every bank did a little bit differently. All you're doing is proving the spending. And so even if you were, reimbursing yourself $10,000 every 2 weeks for payroll and then $5,000 a month for lease, and like you were timing your cash flow and usage of that loan monies according to how it used to be set up. We were thinking 8 weeks, we have time to spend 8 weeks of money. So we were tracking how we were spending that money and basically only reimbursing ourselves. And when it comes time for this forgiveness, it does not need to follow any kind of cash flow trail, especially since lots of banks have done it differently, where they just gave you all the money and then you just did whatever you were going to do with it. And some people set up a separate bank account for it to sit in while they spent it. Others just brought it into their operations and then paid payroll from it. So when you're providing documentation for the bank, they are going to be looking at what were my wages, and you're going to need payroll company reports. Whoever your payroll provider is, you're going to need reports from that system proving that you paid payroll, as well as that you filed payroll tax forms, claiming that you submitted money to the IRS for the taxes that were withheld and the employer portion of those taxes. Those, again, are not going to necessarily equate to the wages that you're claiming, because there's the limitations of the $100,000, and there's the owners are treated differently, and then there's those who have some wage reduction analysis, and you may be paying people for 24 weeks, but then you decide to only claim 18 weeks worth. And so there's just too many different variables that they're not tying out to your GL or to your payroll tax forms. They are using your payroll reports. Those are the number one, your payroll reports. And then they're going to look at your bank statements to watch that payroll come out of your bank account. And so they need to see both of those pieces just to confirm that you legitimately paid the money. And then they need to make sure they could see, check on employee by employee whether the number you reported as wages paid to them is accurate. and that you didn't just say, well, I paid everyone $46,000 and moved along. And so I hope that's helpful with some more commentary around that. Anyway.
Megan,
yes,
one comment.
Yep.
Some of the banks will accept third-party payroll provider reports without verification that it came out of your bank.
Awesome. Are they not? They're not. They're not requiring bank statements, because I feel like they're.
I'm more familiar with ADP. There's a report from ADP that's called a cash needs report, which shows what was to be paid. And the banks know that ADP will not pay that payroll unless the cash is available. And so they're accepting that report in lieu of bank statements.
Great. Yeah, that's great. If you're using QuickBooks for your payroll, that report would not be available, and so you have you do have to show that money coming out. In fact, I had one client who had to they had to note, here's my direct deposit withdrawal, which was easy, but then here's all the checks for all the people who weren't on direct deposit. And because they wanted to be able to see, here's my payroll report, and then here's all the withdrawals from the bank supporting my net pay. And so thankfully the banks are getting more trusting of the payroll reports, but so far, you know, on the QuickBooks side of things, it is they've asked for that extra bank analysis. Okay, so another question. Initially, the bank had 60 days to review forgiveness applications, and the SBA had 90 days. Does the new form start the 90-day clock over again? And what if they don't give a determination within 90 days? And so I don't know the answer to this. I don't think it starts over a 90-day clock because of what my experience is, which I was going to get to in about 3 or 4 minutes. What is that with this new form, the SBA is going to ask the bank to request this information, the form 3509. The SBA is going to say, oh, we need this information for this loan application. And the bank is going to notify the client, it's going to notify the borrower and say, you have 10 days to get us this information. So I do believe that since they're having a 10-day clock, and then the bank has 5 days to dissect it and help the client make any fixes, and then get it to the SBA. So that's a 15-day window, actually. I think that what they're doing is expecting to stay within their 90 days. That's my interpretation of the situation. But we don't actually have guidance on this because the SBA has not actually finalized this form yet. We think it's going to look just like it looks right now, but they haven't actually published this form on the U.S. Treasury site yet to be official. It is a SBA form at this point in time versus that they're using. And so we expect there to be more guidance down the road once they figure out how long it really takes them to do this. But right now, I think they're trying to stay within the 90-day window. So hopefully that helped. Okay, so some of the complexities I did want to kind of go into. We have, just to review, we kind of talked about this FTEs calculation. Just to walk through the calculation real quick. You're going to take your total hours paid during the period. So this is one option, by the way. You divide by the number of weeks in that covered period, and that gives you an average hours paid per week. And then you're going to divide that by 40 to determine your FTE. And then your second option is you're going to say, well, what did I pay on average over the week? Because you may know that data. You may have an hourly breakdown, and so you can take an average. You include your zeros in that average, because if someone no longer works for you or somebody is new working for you, even if they started 2 weeks ago and they're working full time for you, the first 22 weeks are all zeros, and that person's not going to get a full time FTE for you, even though you are paying them full time, because it is looking at the covered period and it's trying to consider the effect of people leaving and coming, because you shouldn't get a full FTE for people who left, even though while they were here you're paying them full time, and you shouldn't get another full time equivalency for the people who just started, because likely they replaced each other. And not in every case, which is why they're just saying include your zeros for the time they didn't work and get an average. And so then there's an option 3, calculate the FTE each week and take an average, but don't limit it to 0 when you're doing that calculation. Once you have those, then we're going to go to the next one where you're going to say round everyone to the nearest 10th, and then you cap everyone at 1.0, even if they worked overtime. There is an alternative. You can simplify this, and for anyone who is 40 hours or more for average hours work, you can give them a 1, and for anyone under 40, you can give them a half. And the biggest thing here, though, is we're apples to apples. Whatever methodology you choose, you need to do that same thing for your comparative periods. And so you have to make sure you're doing the same calculation, especially on that simplified versus actual. If you're going to use that 1 or the half, you need to make sure you use that 1 and the half for each of your comparison periods as well. After you have this, you're going to remove your owner employees from the FTE lineup. You can do this up front too, and then they wouldn't be in the list, but they don't count. They don't count as before or after comparative or anything. They don't get to count as FTE at all. Those who made over 100,000 in 2019, those individuals need to be in their own table. And so you've got to identify them and pull them out into their own subgrouping. And so then you're going to have your overall FTE, which does not include your owners. You're going to have a table 1 and a table 2. So table 1 is everyone who is either new in 2020 or they've made less than 100,000 in 2019. Even if they make over 100,000 in 2020, doesn't matter. It's what were they in 2019 versus what are they now. So if they were over 100 in 2019, they're in their own table. If they're under or they're new, they're in a table as well. And then you've got to also look at this same whole calculation with multiple periods and dates. So this is just the periods that we've seen as working out or as working into the bank's portals. So of course you have your covered period or alternative covered period. That's your 24 weeks. Then you're going to have your first comparative period, which is January 1st through February 29th. And that's your first comparative period. Your second comparative period is February 15th of 19 through June 30th of 19. And as you know, I put their days of the week here because I'm like, why didn't they pick the end of the week so it's an even week over week analysis? And they didn't do this. So because we're going for an average, I think it's up to you. If you have the information to include the whole week that includes January 1st, then go ahead. Or if you want to ignore that week and just start the first part of the following week, like on the 5th of January, and use that through February, that 1 week is not going to affect your average massively. And so you just, again, you're looking for an average. So just pick one and go with it. On February 15th, that is a Friday. I probably would just start the following week. That's what I would recommend there. So anyway, so those are your comparative periods. You're going to want to do those calculations to see which one compares better. Then your seasonal. If you're seasonal, that means your work, like your company has seasonal activity. your workforce, you ramp up and you slow down from a seasonality standpoint. We're not talking about seasonal workers, like, you know, if you have 2 or 3 people that you hire seasonally, we're not talking about that. We're talking about a big impact to your business. You know, I'm a ski rental shop, and so I'm going to obviously be heavy in business during the winter months, but not so much in the summer months. And so in the summer months, of course, my FTE looks horrible compared to January and February when I was in my crazy time. And so that's where you get the opportunity to pick your own 12-week period from a year ago. So what 12-week period is the most comparative to the current, to your covered period this year? So so that is a comparison. You get to pick 12 weeks from May 1st of 19 through September 15th of 19. And so hopefully that will help you, and it's your choice still. You could use one of the other 2 dates, or you can, it's your option to choose the seasonal period as well. So you're going to just look for the one that's the most beneficial to you as a seasonal employer. And then I have had some banks ask for this year, February 15th through April 26th. And what they're looking for is, you know, statistically, did you reduce your workforce during, you know, you have January to February, but then from February to almost the end of April, did you reduce your workforce because everything shut down? And they're just kind of looking for that data. That information does not really go onto your application, but I've seen banks asking for it. So I put it on here so you could be ready for it if you need to have that number. And then they're asking for dates, not an average on this next group of people, dates, an FTE total company number might be asked for. And so you're going to need to know what the first of the year was, or end of last year, the week including February 15th. And so whatever you pay, like whatever pay period includes that, you're going to get that weekly average, that weekly number, that for that week, what was the FTE on that week? And that's what you're looking for. The week at the end of the covered period. So, you know, if your covered period ended end of November, you're looking for that last week. So you've included that in your whole covered period average, but they want to know what happened on that last week. And then the date of forgiveness application, or 12/31. So if you're not doing your application until next month, you're going to just stop with 12/31. But if you're submitting your application now, they're looking for what's your FTE now. And what that's doing for you is the safe harbor, where if you were down by, you know, you had 30 employees and you went down to 20 employees, or from an FTE standpoint, you have a safe harbor to be able to restore that by the end of December 31st. And so if you're going to go apply for forgiveness now, you're going to get, you're going to report your current week's FTE, because maybe it's back up at 25 and you can get a safe harbor for 5 of the 10 you went down. Again, it's something that the banks are asking for so that they can kind of put that magic into their application forms. But that's why, I guess, I wanted to share why they're asking for that date. And then a few times they're asking for head count. So I've had a lot of them ask for the head count as of the loan application date, which you actually reported when you applied with that lender. And so I've been surprised that the head count isn't something that the banks already have filled out for us. And I think the reason is that we all know more now than we did when we applied for the loans back in April, May, June. And so I think they're asking for this number again. And it's really just a chance to say, okay, yeah, if I'm comparing apples to apples, my head count now versus my head count then is X number of employees. And so this is a total employee headcount, not an FTE. When they say headcount, they don't want to know your FTE. They want to know how many people were on your payroll run on the date on the pay period that includes your loan application date, and then your pay period that includes now, forgiveness application date. So those are what I've seen. And then we have our wage reduction analysis. This is kind of shifting over. You do have to do analysis for every employee. A lot of our clients, the experience is that they have not reduced wages. They've reduced hours, and that's in your FTE analysis, but they haven't actually reduced their wages. So we kind of went through an example last week, and I just want to kind of pull up the final result of what we're doing. But basically, you look at what was their salary for the year, what were they paid during the covered period, how much is acceptable to do 25% reduction. So what is the unacceptable portion? The unacceptable portion is $11,250 was the unacceptable portion of reduction of wage reduction. And therefore we have to take that and say, well, okay, well, we want to take 24 weeks of that, and we get to the 5192 in our example. So before I go on to the next thing, let's make sure we're covering our questions here. Okay, the head count, including owner employees. Yes, actually the head count does include owner employees. The FTE does not, but the head count does. When you were applying for a loan application and they said, how many employees do you have? For all those who were self-employed and just filing on a Schedule C with no employees, they were to put 1. And so the head count does include your owner employees. Okay, so it looks like we're going to go ahead and move into the next group here, the loan necessity questionnaire. I do want to cover this. This is, sorry, I'm just watching to see if there's another question that popped up. Okay. The overall premise of this is, as I talked about, was to evaluate whether you should have had the loan. And so there was this economic uncertainty that made the loan request necessary. And I mean, I don't know about you guys, but at the time of all these loan applications, well, everyone was experiencing economic uncertainty. I don't know if anyone could have said that they weren't, like, oh yeah, we're fine, we got this. Like, nobody felt that way during the beginning of COVID. And so it is very legitimate that so many people went ahead and applied for the PPP loans. And so the leg that they have to stand on is, after a month, they're saying, well, do you really need it? And they kind of gave some parameters of people who are public companies, people who have access to line of credit from their lender, people have all these other things that they could have pulled that money down to survive on instead of the PPP money. They're saying that those people shouldn't have taken it. And so that's what they have come back here to and said, we're going to ask some questions and we're going to see if you really needed the money. And like I said earlier in the presentation, we don't know what the aftermath of this looks like. We haven't seen anyone be affected by the result of this. We've had a few clients get this requested of them, even if they were even under the $2 million amount, but we haven't seen the ramifications. We haven't seen whether it results in a zero forgiveness scenario or a partial forgiveness scenario. We don't know yet what this looks like. So all we can talk about is the reasons why we think it's here. So one of the things, so on the form 3509, first they do a business activity assessment here. They are talking about the gross revenues, your employment, your operations, your COVID costs. They're wanting to know information about this. Your gross revenues year over year, looking at Q2 of 2020. So I have a few clients who on Q3 of 2020, they figured some things out and they noted they experienced a pretty sizable upswing because of, because of the economy, because of COVID. They found that they were becoming successful amidst the crisis. But Q2 they didn't. Q2 they were still dipped down and they were having a hard time. So the nice thing about this questionnaire is it's really looking for that second quarter, that initial hit, what happened during that second quarter. And so looking year over year. Now they ask for just Q2 2020 versus Q2 of 2019. If I were somebody who was experiencing high growth from 2019 into 2020, so 2019, maybe I had $2 million of revenue in Q2 of 2019, and Q2 of 2020, maybe I had $3 million, but my Q1 of 2020 was like $8 million because I've been growing since a year ago. And so if I were them, I would overshare a little bit to provide some context. I would say, look, if I look at if I include 2018 and show my growth to 2019 and my growth to 2020, yes, my revenue year over year is stable or a little bit growing over the year, but it's not stable compared to my projected growth. I would totally be showing that in response to this question, if that makes sense. So I'm trying to tell my story in all of this. They're asking for business shutdown, significant alterations from COVID health department orders, cash outlays and costs for making those alterations. I think most businesses did experience cash outlays. I mean, how much were some people trying to pay for Clorox wipes because they were so scarce? And you have your voluntary shutdown too. You just felt like it wasn't safe for your employees to be at work. You weren't necessarily shut down from a health code standpoint, but you did voluntarily shut down because the people who are working for you weren't safe. And so then they're going to ask you about new capital improvement projects not due to COVID that you started between March 13th and your end of 24 weeks. And if you did do that, that's going to look bad on you. So if you started capital improvement projects, started building a building, things like that, that weren't related to, there's people who like busted through walls in order to have a drive-through option at their restaurant. That's not, that is due to COVID. That's not what they're asking. They're asking for the people who did big expansions to their office and built new buildings and, developed new equipment and things like that. Those capital improvement projects, what it will look like is that you use the PPP money to go improve your business instead of using it for operations. And so again, you're going to need to provide it with context. You're going to say, look, my capital improvement projects, I always have stuff going on. And this is what I've spent capital improvement all of 2018 and 19. And here in 2020, I actually dipped. I couldn't do all my capital improvements that I expected. So things like that are going to be, you're going to do some of the questions, you're going to provide the bare minimum that they ask for. But if your bare minimum doesn't tell the right story, then you're going to want to make sure you add the context. You don't want to send the message of, yeah, we grew. Yeah, we did capital improvements, when really you were hit. You do have your trends show hit. You took a hit during COVID. And so you do want to make sure you're following that. And if your 24 weeks isn't over and you have capital improvement projects planned to start soon, I would maybe delay their start until after your 24 weeks, just so you don't have to get hit by this, if that's possible. So, okay, then they are going to do a liquidity assessment. So in the liquidity assessment, they're doing an analysis of what did you do with the money and how could you have gotten more money. So did you distribute to owners? It's okay to distribute their tax liability coverage. But if you're just distributing money to them and you distribute them, $300,000, they're going to look at that and say, that looks like PPP money getting distributed, even though it may not be at all. Prepayment of debt before the terms. So even as simple as paying off a line of credit, if you just paid that off because you had the PPP money, you had extra cash flow, that's going to look bad. They're going to say, well, that doesn't look like you needed the money if you're able to pay down your line of credit. If you paid any owners and employees more than $250,000 annualized during the covered period, which is $115,385. So this is just reporting. I think they never put any rules out there of how much you could compensate someone, but I think what they're looking at is, hey, don't you think your owners could have not taken their, their full wage in order to keep the business afloat? And so if you've done this, if you've paid employees or owners more than that annualized amount, that $115,000, then you might run into a situation where the SBA doesn't fully forgive your loan. If you're a public company or owned by a public company or private equity firm, 20% or more, they're asking for that information. And they're probably going to go look at those entities to see how liquid they are, to see if they could have contributed to your success to your survival, I should say, instead of PPP monies. And then they're going to look at what was the value of your shareholders' equity. Your shareholders' equity is an account in your books that signifies how much money has been left in the company, like your net worth, almost, not worth from a value standpoint, but from an accounting standpoint. How much cash have you left, cash and assets over your liabilities have you left in the company? And so they're going to be looking for that. And then, did you receive other CARES Act funding? This is just a question that they're asking everyone. It's not necessarily going to hurt or help on this one. Let's see. Then I did pull this in. This is a new slide from last time. This is the nonprofit differences. So if you're a nonprofit, they call it the nonprofit activity assessment instead of business activity assessment. They ask all the same things, except they want to know what's your expenses year over year. How much does it cost to run your nonprofit? They don't ask that of businesses, but they do ask that of the nonprofits. And then the liquidity assessment looks a little different. And the fact that it's saying, what do you have as liquid assets? What are your restricted funds? So you have cash, but it's restricted. So you may not have been able to use those restricted funds for your payroll and mortgage and lease, etc. You have to report whether you have endowment holdings and endowment funds. You have to report the value of your non-cash investments, so equipment, stock, things like that you might have as investments. And then they ask a question, which is interesting. Did you discount your service fees due to COVID? And if you are in the education or the healthcare services industries, they're going to ask you a little bit more detail related to that. But those are the differences. That's what Form 3510 shows. So just some of our takeaways from that questionnaire. We expect there will be changes, but this is not something you need to provide to your bank up front. This is something that you will wait until it's asked for, but I would definitely read through the questions and document dates, like when did you shut down? At what point were you asking employees to come back? Are you still shut down? Are people still working from home? And so you don't always have to require supporting documentation. Some of them are just what's your value of assets. It's $100,000, and it doesn't ask you for a schedule of what those are. And so don't give them that. There's no need to overshare unless, like this last bullet point, you're telling your story. Make sure you understand why they're asking the question, so that you can provide the commentary and context and trend analysis that would help your case. And so anyway, I hope that those are helpful. It looks like we've addressed the questions that have come through. So now that we're down to our last minute, just open it up for anything else, any other questions that you guys might have. We're happy to stay on a few extra minutes and answer those for you guys. And then of course, here is my information and Tim's information. If you need to email us, you're welcome to reach out to us. And I still don't see any Q&A that's come in, so I think we can call it a wrap.
All right, thanks so much, Megan. Thanks for joining us.